Hey there folks, it's Mark Russo here, your go-to financial expert, and today we've got a video that's going to make you sit up and pay attention because we're diving headfirst into the turbulent waters of the American economy. There are two dividend stocks that are sending shivers down my spine, and I can't wait to break it all down for you. So grab your life vests, because we're about to navigate these treacherous financial waters together. Now let's start with a stock that's making waves for all the wrong reasons, Zim Integrated Shipping Services, or simply Zim. You might have heard of this Israeli container shipping company, and what's caught everyone's attention is its deceptively high dividend yield. But, my friends, this isn't a story with a happy ending. Zim has a market cap of a measly $1.4 billion, which is like a dinghy trying to weather a hurricane. Over the past year, the stock has been caught in a brutal tempest, plummeting a jaw-dropping 75%. And if that's not alarming enough, it's down 30% year-to-date. That's like trying to swim against a tsunami. So, what's causing this financial shipwreck? Well, Zim recently released its Q2 earnings report, and it's enough to make your heart skip a beat. They posted a net loss, a whopping 87% drop in adjusted EBITDA, and it's all because of sinking freight shipping rates. Imagine being on a vessel where every wave feels like a potential disaster. And let's not forget about the cash situation. Just 6 months ago, Zim had $4.6 billion in cash on hand, but that's dwindled to a mere $3.2 billion. They're bleeding cash faster than you can say, abandon ship. The analysts are singing a somber tune too, predicting more net losses for Zim in the next 3 years. It's like watching a financial Titanic in slow motion. Now here's the real red flag. Zim recently pulled a move that should make all investors quake in their boots. They skipped their Q2 dividend payment. Yes, you heard me right. They couldn't even muster up the funds to pay out a dividend. It's like a captain abandoning ship when things get tough. But wait, the storm isn't over yet. Our next financial tempest comes in the form of United Parcel Service, or UPS. This global logistics giant, with a market cap of $144 billion, is facing some turbulence of its own, and it's not looking good. UPS found itself in some intense labor disputes and, in the end, had to agree to substantial pay raises for their workforce, which numbers over 300,000 strong. While it's fantastic news for the workers, it's like a perfect storm for UPS's bottom line. Now here's where it gets really concerning for investors eyeing UPS. I'm sounding the alarm that UPS's once robust dividend growth rate might hit some choppy waters due to these labor-related costs. The dividend growth rate, which was once on the rise, could slow down significantly. Analysts are projecting a grim 26% drop in EPS for 2023. That's like hitting an iceberg in the middle of a tranquil sea. Meanwhile, their rival, FedEx, is expected to sail ahead with faster EPS growth. It's like watching FedEx catching favorable winds while UPS struggles to stay afloat. Now, what does all of this mean for you, dear viewers? Well, here's my expert advice. I'm steering clear of Zim indefinitely. The fundamental issues and the stormy seas it's navigating are just too much to handle. As for UPS, I'm avoiding it in the near term. There are underlying issues that could send this stock into rocky territory. I'd rather be safe on the shore than caught in a financial tempest. So, there you have it, folks. The American economy isn't all smooth sailing right now. These two dividend stocks, Zim and UPS, are sending distress signals that we can't ignore. But I want to hear from you. Drop your thoughts in the comments below. Are there any dividend stocks you're avoiding like the plague? Let's have a discussion, because when it comes to the stock market, it's always better to weather the storm together. Until next time, stay financially savvy, and don't forget to like and subscribe for more hard-hitting financial insights.